everybody. Just getting organized here. Hope you're all having a good morning. It's election day. We got that. Let's get rid of Ion's music. We are live on Facebook, LinkedIn, YouTube, X, Instagram. Are we good to go? I think we are good to go. Welcome everybody. November 5th, election day, episode 299. Welcome to Mornings with Scott, the best damn business show for medium and small businesses on the planet. As you can see, I'm traveling. I told you I'd be traveling all this week, a little bit of next week too. And so I'm in the Calgary pad this morning and heading to Toronto later today. So we'll see. Are you nervous? How are you feeling about election day? I'm a little bit nervous about this, but I just have to say, after years of intense campaigning, bad-mouthing, calling each other stupid and fascist and Nazi, this is the time. This is the time when we should all come together as a nation, and we should, with unity, just say, may the best lawyers win. So we talked about Warren Buffett yesterday and Berkshire Hathaway, and we ran out of time, as you may recall. And one thing I want to talk about is that a note in that Wall Street Journal article that Buffett said, hey, don't look at our net income. Like, our accounting metrics don't make any sense. Don't value our business based on net income because it has unrealized gains and unrealized losses on assets that can be marked to market. He didn't say that, but that's what he meant. He didn't say that because it's too complicated. Who the hell would know what that means? Well, what it means is if you're in the business of investing as a company, in part in business, he has operating businesses too, right? Insurance and other operating businesses like a normal holding company. Hey, Ashley on Facebook, thanks for joining us. And so, but he also invests in securities. Apple, we talked about yesterday, American Express, Bank of America. He's been liquidating those assets. So as the market, so you carry those on your balance sheet as an asset, right? Like I have all of these investments in the market. Market goes up. Well, that's a gain for accounting purposes and what they call an unrealized gain. Why is it unrealized? Because you didn't sell it. You still own it. You pay $100 for a stock. It goes to 150. You have a 50% gain, but not really. You don't have the cash because you haven't sold the stock. You only realize your gains or your losses when you actually sell. But for accounting purposes, in the old days, we used to do what's called historical cost accounting. And so we had that stock on our balance sheet. It'd be $100. It'd just be $100 until we sold it. Then we'd have a gain or a loss. And then the accountants, of which I'm one, said, "Now, wait a minute. We should be doing mark-to-market fair value accounting, and which means that whenever we do a reporting period, month end, quarter end for the public companies, year ends, we should say that stock is really worth $150, not $100, and we should take that in that $50 unrealized gain into income, which just, you didn't really make that money because you haven't sold it. And so Buffett's properly saying, look, this is kind of screwy for our business. And so what we should do is ignore the net income that we have to report under generally accepted accounting rules, principles, GAAP, GAAP. And that's how the standards with which you report in whatever jurisdiction your business may be in. And so Buffett says, let's not look at that. Let's look at this line item. Operating income is what the Wall Street Journal referred to. But if you think it's just Buffett, it's not. It's almost every company. Almost every company that reports, including your medium and small business. Well, you ought to be anyways. You should be your medium and small business. Every company is looking for different metrics to report on because GAAP does not work for them. I say that as an accountant. I hope I don't have some sort of professional responsibility, but accounting has evolved in such a way that it's not entirely useful for the users of the financial statements. Have you ever looked at Canadian? Can I even say this word without getting my channel shadow banned yet again? I'm going to do the short form. WEED companies in Canada. They have a bunch of let's say, farmed goods on their balance sheet, plants that are growing because they're in the agricultural health business. And it's the same thing. You have to mark to market that inventory. And if you're trying to look at one of these reporting companies that are in the business of WEED, you will get these huge swings in the value of the inventory, and those changes go onto the income statement, and they just mask otherwise what's going on in their operations. And so as an analyst, as a manager, as someone trying to help one of these companies, you have to just go in and like take out those unrealized gains and unrealized losses to even come up with something useful. So that's what we do. We ignore the GAAP, generally accepted accounting principle statements, and we come up with non-GAAP measures to follow, which is a shame. I don't think we should have to do that, but more and more, this is becoming an issue in accounting as we move away from historical accounting and just make things more complicated. Financial statements are too complicated, and they're too dependent on volatile swings in markets to be useful to many users. And so, like I said, we make up our own metrics to track along the way. Did you know, for example, excuse me one second here. Calgary allergies always kick in. For me, it's so dry up here. Did you know, for example, that EBITDA, EBITDA, earnings before interest, taxes, depreciation, and amortization, if you're a manufacturing company, for example, almost any company, this is what you want to track as your valuation metric. Now, I might disagree that that's a decent valuation metric, but it doesn't matter what I think, what Scott thinks, because that's the market. Like business owners, investment bankers are going to track your EBITDA. They're going to look for the growth that we talked about yesterday, and they're going to come up with a multiple on EBITDA. But did you know that EBITDA isn't even reported on financial statements? It's not a measure. It's not a GAAP measure, generally accepted accounting principle measure. It just isn't. It just isn't. And so it's not on your income statement. You can't look on your income statement and see a number called EBITDA. Now, you may find a number called operating income, which coincidentally may actually equal EBITDA, but there is no formal definition of EBITDA depending on the jurisdiction you're in. And so what companies do is they, in the little notes to the financial statements, they create their own EBITDA metric. They define it how they're supposed to define it, or they want to define it, or they even better yet come up with a air quotes normalized EBITDA, which means, like, I know most people calculate EBITDA this way, but we calculate it a different way. And there's your disclosure. So we're always forced to sort of come up with different metrics on our financial statements to make them useful to it. And as a CPA, as an accountant, one of my pet peeves for a long time has been that these financial statements are too complicated. They're not useful for most executives, most business owners, most, let's say, retail, super sophisticated investors. And that includes for your medium and small business, the financial statement that you get from your external accountants every year, right? You do your internal numbers, your controller does something, they send it off to the external accountant, and they prepare a notice to reader financial statement or review financial statement or audited financial statement. God forbid you spend the money on that. And you're not getting necessarily what's going to help you manage, like contribution margin, for example. In all of my content, in my courses that you can go buy, there's a link in the notes below, focus heavily on managing through contribution margin. Well, that is not gross margin. And the financial statements report gross margin, which is not helpful really in many instances to you in managing your business. We already talked about EBITDA. The cash flow is not really cash flow. It's a weird number. It used to be what's called a statement of changes in financial position. Now it's sort of a cash flow, but it's not useful from an analyst and a management perspective. Even your working capital is weird with the mark-to-market stuff. And so there's a lot of stuff going in a financial statement, which in my view make it, it's not even my view, it just makes it overly complicated. I mean, so many business owners in our advisory practice and our investment practice that just, they don't understand their own numbers. They don't, because they're not sophisticated in accounting. They don't have the business literacy to review their statements, and and it's a problem. And as accountants, we make this way too complicated. So what's the solution to that for your medium and small business? Well, I have an answer. Sinclair Range, my company, offers fractional CFO, controller, and accounting services more for the smaller businesses. Let's call it lower mid-market to small businesses. You know, business and transaction success relies on accurate and timely financial reporting. But this level of reporting can be costly, super costly, really, really costly, or unavailable to small businesses. Somewhere in my notes, I talked about the cost of this, but one of the things as the accounting becomes more and more complicated, that the rules become more and more intense, is that the level of professionalism has changed, certainly from when I was younger. And so you're getting this really a big divide between the accountants that really know what they're doing and current or on top of stuff, and the accountants that aren't really that good anymore. And the ones, because they're out of date and they haven't kept up with their continuous training and all that sort of stuff. And then the continuous learning. And then the, to get a good internal controller in a lower mid-market or smaller businesses, it's just too expensive. It's too expensive because these people that offer, take those sorts of jobs have been training and going to school and training, and they need to be paid. They need to be paid a high number. And I just feel like there's a disconnect between the price of a quality accountant in many, many, many places, and the needs of the company and what they can afford. And so Sinclair Range is filling that void. We offer virtual and fractional CFO, controller, and bookkeeping services that's tailored to meet your needs and your budget, all at a cost that is a fraction of hiring comparable skill sets full time. If you get into the Sinclair Range services, you'll have accurate and timely information to make critical decisions. There'll be, you'll have professional reporting that you can use with lenders, investors, stakeholders, right? Send it to your bank. If you're trying to raise money, this is a good service to have. There'll be regular coaching sessions, like literally with me personally. That's part of the service. So you get sort of a high-end, little bit of time each month to discuss what your numbers mean, what you ought to be working on. You get access to the entire Sinclair Range team, of which there are many, many CPAs and accountants that are there. It's terrific. And you'll have someone to call or to reach out to with a CFO level experience and training in the middle of the night when you have all these worries or an idea that you want to talk to a financial person about. You cannot afford this service hiring full-time as a lower mid-market or smaller business. So come to us. Let us handle that. There is a link in the notes to this live stream where you can go to the Sinclair Range website. You can read about that service a little bit more, and you can reach out to us to talk about how to handle that. Have I ever told you, maybe I haven't, that, well, here's a quote from Benjamin Franklin you might like. Energy and persistence conquer all things, from Benjamin Franklin. Energy and persistence conquer all things. Can we look at Trump? Can we look at Trump? It is election day for validation of this. Have you ever seen anybody with more energy and persistence? Has anybody ever overcome so much? You may not vote for him. You may hate him. You may think he has terrible character, like many of my listeners think. But you have to admit, he overcomes a lot, and he pushes through, and he has a lot of energy and a lot of persistence. Benjamin Franklin, energy and persistence conquer all things. Well, I've been working on, I've ever told you that I'm starting a business. I've launched a business course. There's a link in the notes on that too. If you want to learn how in your small and medium-sized business to earn more money or raise business capital, you can join this super cost-effective, really intensive academic learning on business, but it's practical. It's based on my coming up to 35 years. Is that the right number? Oh my goodness. Of working with businesses to improve earnings, to raise capital. The first module was on continuous improvement, managing through key performance indicators. The second was on literally how to build a cash flow model to manage your cash flow, understand working capital cycles, really hands-on. There's screenshots and share screens of how we build this sort of financial module. Well, module 3, which should be released November 15th, we're trying to release one module per month. And so I'm traveling right now, but I did bring my equipment to shoot that video, which hopefully I'll be doing probably from Toronto somewhere. But this module is about energy. And so, by the way, it applies to your business, but it also applies to this is one of those things that applies to your personal life as well, your career, just wandering through life as a human being. And specifically, it's about how to manufacture momentum, as I said, for your business or for your life. Things that we're going to talk about, if you really break it down, is how to limit negative energy, right? How to ring fence the amount of time that you're spending on negative things, and to eliminate negative episodes and people from your life. How to move your business and yourself, if you need to where the energy is. Energy is where you get better opportunities. If you go to where physically or virtually to where the energy is, that's where you find luck. That's where you find opportunities. And so we're going to talk about strategies in this module to actually do that and to create winning momentum. What does that mean, winning momentum? I describe it to employees as the feeling you get when you wake up tomorrow or this morning, and you know that today is going to be a little bit different a little bit better than yesterday. And if you are working in a business with positive winning momentum, you'll know that feeling. Hey, I'm excited to go to work today. Everything's going to be great. If you're working in a business with negative momentum, you're going to wake up this morning and go, oh, this is going to be a little even worse than yesterday. What a shit day I'm going to have. You feel down. You feel heavy. It's not going to be good. Or sometimes you're in a business with no momentum at all. You just like that, whatever. I don't really care about my work. The momentum, the energy of a business really impacts your energy at a human level, how you feel as an employee, as an owner. And so, so winning momentum to me is critical. And the good news is it can be manufactured. So this business course, as I said, is about how to earn more profit and make and raise capital for your business. Well, creating winning momentum is a super powerful way to do both. Hey, Brian, thanks for joining us on Instagram. And so winning momentum, creating manufacturing momentum is a super powerful way to do both. Because why? Because winning momentum attracts resources. It attracts energy and attracts resources. And when I say resources, I mean both financial resources and human resources. If you're looking for a job, do you want to go to the company that's you just like it's got a bad vibe, it's going downhill, it's dirty, it's dingy, and it just seems to have losing momentum? Or do you want to work for the company that everybody's talking about, has got the buzz, it's in the news, and when you go there, there's just an energy around it? You want to go work for the company with the good energy. Which company do you want to invest in? It's obvious. You can manufacture this momentum. You can manufacture this energy. And that's what that module 3 of the course is going to talk about. If you want to go buy that course, it is the best value for money you will ever find. How many times have I told you that the new bubble for you investors, or if you're looking for where the energy is, and that is a pun that you don't even understand yet, but nuclear energy is the new bubble. It's one of the new bubbles anyways. Well, Wall Street, we've talked about that over and over on this show. Well, Wall Street Journal reports that shares of nuclear power producers fell after, just checking my time, after regulators dealt a blow to the Amazon.com effort to use more nuclear energy one of the several, as technology giants turn to the power source to fuel the rapid development of artificial intelligence. We've talked about that before. You remember we talked about the conversion of old nuclear plants in Michigan, 3 Mile Island. I think there was one in Alabama, and it's all intended to drive the server farms, or whatever they're called, to where they work on the artificial intelligence data, which is a huge issue. So the Federal Energy Regulatory Commission, FERC, late Friday blocked a request by Amazon and Talon Energy to siphon more electricity from a Pennsylvania nuclear power plant to one of the internet retail company's data centers. That was the word I was looking for, data centers. So the shares fell. The shares fell on Talon. The shares fell sort of across the board in the nuclear energy. The news hit other nuclear heavy power companies whose stocks have surged as Amazon, Alphabet's Google, Microsoft, and other tech companies have inked deals to use carbon-free nuclear power to meet increasing AI-fueled demand for electricity. Constellation Energy, which plans to restart, there you go, the Pennsylvania's 3 Mile Island power plant to sell electricity to Microsoft, tumbled 11%. Yesterday, beating market expectations with its quarterly earnings and boosting its outlook. And then Vistra, Centrus Energy, NewScale Power, Public Service Enterprise Group, all were hit earlier Monday. So basically, there was a meltdown in nuclear. Did I do this whole story just to say that? No, I did not, but I like it. I came up with that in my sleep this morning. So FERC's rejection appears to be more about technical issues than broad policy, said a UBS analyst. And we believe investors should focus on the strong fundamental backdrop. So nonetheless, Constellation was way down. I'm not buying any of this. I think this is just a tick. I think it was an overreaction by investors, so much so that I went and bought an option on Constellation this morning, and it's already in the money. It's already in the money. I'm telling you, pay attention to this sector. A friend of the show, Rabbi Moskowitz, you can look him up on LinkedIn. Look up Rabbi, Zeke, Z-E-K-E is his nickname, Moskowitz. And he is all over nuclear all the time. And he posted, I think it was this morning, that the recent FERC decision has sent shockwaves through the nuclear energy sector, causing a significant drop in stock prices. We already read about that. And then he says that while the initial response was negative, a closer examination suggests that the ruling could actually benefit the nuclear industry in the long run. Here's why. It protects current supply, encourages new development, and it promotes long-term industry growth. And it's also an opportunity for nuclear startups. Now, his post was way more involved with that. So I would urge you to go read that post if you're interested in this space of Rabbi Moskowitz, okay? But the bottom line is, in the big picture, it underscores, I think, something as Rabbi Moskowitz says for long-term investors, which is you can look beyond short-term market movements and consider the long-term implications of regulatory decisions on industry dynamics. What does that mean? Well, the agencies, the government in the US, and I think no matter who wins the election today, are embracing nuclear energy as a solution to clean energy going forward. And therefore, the regulatory agencies are starting to grapple with the issues that come out of that. And that's a positive thing. You want industries to be properly regulated, and you want those regulations to be stable. You want them to be sane. You want them to make sense, and then you could go operate or work or invest in the business. So it's a good thing. It's a good thing in the bigger picture, just like it would be a good thing for Bitcoin if that was regulated and everybody understood those regulations. Then what could happen? Well, the big buyers, the institutions, would feel safe getting into that space more than they have been today. I've been telling you since I started this live stream back, I think July, that we're in a recession. in both countries, in Canada and in the US. It's not a disclosed recession. The data doesn't support that, but all the data is crap. We've talked about that over and over again, particularly in an election year. And we've gone over huge numbers of examples, anecdotal as they are, of why the economy is not in good shape. It's bifurcated. Like there's the really wealthy that have access to all of the free money and liquidity in the system. They do well. They do very, very well. That's why your stock market's way up. That's why real estate's way up. But the other people just can't afford anything, and they're not doing so well. Another example this morning is a lot of the restaurants in the US have been reporting their earnings, the big chains, the ones that are public, and they're all off. They're all off top line. They're all off bottom line. In other words, they're not. In other words, people can't afford to go eat in a restaurant, which is pretty sad. But also, the professional firms are laying off, which is always a sign that things are not good in corporate America or corporate anywhere. Things are not good because you start looking at the amount of money that you're paying your accounting firm, your consulting firm, your law firm, and you start saying, wow, I would like to cut 20% off that. Well, KPMG, international accounting firm of which I am alumni, is laying off hundreds of employees in its US auditing business as it works to make up for lower levels of turnover. KPMG is laying off hundreds of employees in the US auditing business as it works. This is from the Wall Street Journal, by the way. Let me just read the same note over and over again, so I'm repeating myself. The move follows several rounds of KPMG cuts in the US, including an audit-centric round in March. Last year, KPMG laid off 5% of its US staff, including advisory, tax, and back office workers, basically throughout the firm. They've just been cutting back. Why? Because corporate America can't afford those services anymore, no more than you and your medium and small business can afford the services of a proper controller, which is why you should come to Sinclair Range and get that fractional service intended to help you off. By the way, I said I was KPMG alumni back in the 90s, I guess, or was it the 80s? No, it was like the late 80s. I'm embarrassed to say how old I am. In the late 80s, when I was a young associate at what is now KPMG. It was a different name back then, but it, through the mergers becomes KPMG. And I was in Toronto. I had moved from Ottawa to Toronto. So I'm working there. I'm out on audits, and we were going through, the whole economy was going through exactly what it's going through right now. And professional firms were cutting back huge. And KPMG, in their wisdom, back then to sidestep some sort of labor rule. I don't know what it was, but they couldn't do a mass layoff. And so they said, well, that's cool. We'll do layoffs. In smaller chunks. Specifically, every Friday, we'll lay off some people. And that lasted all summer that I worked there. And so it's hard for me to even put into words what that does for morale in a company like KPMG. But it wasn't even a joke. It was for real. If you were called in from the field to go to a meeting at head office back where you work on Friday, don't go. And that's what we used to do. I was actually called to a meeting on Friday. I'm thinking, that can't, I was a star. They're not going to get rid of me. Turns out it wasn't to be laid off. It was something else, but I thought about not going. KPMG is among the largest accounting firms that have continued to experience slower than expected revenue. And here, the bottom line, as I said, is that businesses are cutting back. And I'm running out of time. So do we really need to cover the rest of this story? I don't think so. I think I've made my point. It goes on to talk about artificial intelligence. It's in the Wall Street Journal if you want to look it up. But I would just want to say that the economy is not good, which means what? It means in your business, my business, we need to focus on priorities. We need to manage our cash flows, and it doesn't matter who's elected. It's not going to change anytime soon. And if one of those two candidates is elected next year, things are going to be really, really bad. I've talked about that over and over again. So hunker down, head down, don't spend your money on frivolous things, and get back to work. No matter what happens today in the election, get back to work. I'm over time. I'm traveling. I should be able to do this from Toronto tomorrow, 8:30 a.m. Mountain, 10:30 Eastern. Thank you for joining. This has been Mornings with Scott. We'll talk to you tomorrow.